Hey there everyone, welcome to this new video. In this video I'm going to cover the a very good and effective forex moving average based strategy. But there are some few prerequisites I want to cover and clear some of the misconceptions traders have regarding the forex moving average. So in this short video, here's what we are going to cover. We are going to take a look at what are the different ways of using forex moving averages. And then followed by what is a simple and yet effective forex moving average based strategy, and what are the prominent mistakes to avoid when using the moving averages and the crossover. So here we go. There are two most common types of moving averages. The one is the simple moving average and the other is the exponential moving average. In the exponential moving average, the more importance is given to the recent price, whereas the simple moving average gives importance to all the price points equally. Now when it comes to moving averages, there are two more common uses that traders have. They use the moving averages when the price, for example, bounces from the moving average, or the second is when the moving average crossover. So if you look at this chart here, if you look at this point, this is where the fast moving average is crossing over the slower moving average. I have plotted this a 50 moving average and the other is the 100 exponential moving average. As you can see here, 50 EMA crossed below the 100 EMA. So this is the crossover, and typically a lot of traders, they enter a position when this kind of crossover happens. And now this is the other kind of use where you see the moving average has kind of bounced off from the the price has bounced off the moving average, and the same thing, if you see, it happens here also. So there are some misconceptions around the use here also. I'll come to that in a minute. But these are the two important forms of using the moving average. One is the crossover and the other is when the price bounces off the moving average. Here are some important points which I want you to take note of and remember. Typically, as per my experience, exponential moving averages, they are more accurate than the simple moving average. I don't know what is the reason. I guess the reason is because the exponential moving average plays more importance to the recent price points, whereas the simple moving average, they tend to give equal weightage to entire all the prices or all the candles. Moving average crossovers are not effective for entering trades. Yes, let me repeat it again. The crossovers are not effective for entering trade. That's because they give signal a bit too late. For example, if you see here, this is where the moving averages are crossing over. But if you look at the price is already far from the moving average. So if a particular person, for example, tries to take up entry here, the price may retrace and can hit the stop loss. So entering a position when the moving average has crossed over is not effective to a large extent. The moving averages are very effective to enter a trade when the currency pair bounces from it. For example, if you look here, the price, it touched the moving average and then it retraced again. So entering a position using the bounce from a moving average is very effective, whereas the crossovers are not effective to enter a trade. What the crossovers does is it can give you a fair good indication of which direction the price may continue. For example, a crossover here gives an indication that the market will continue moving in the downward direction, but its use is not good to decide when to enter a price, when to enter it, or when to open a trade. The other point, to use moving average effectively, the trader should know candlesticks very well, because the candlesticks can help you decide whether price has returned or price has bounced off, whether you should wait for another candle or is the current candle good enough to enter a trade. And one more thing, don't plot more than 2 exponential moving averages on the chart. If you plot, for example, 3 or 4 or 5, it's just going to confuse you. It's just going to lead to some kind of indecision for a trader. 2 moving averages are good enough to decide which direction the price is moving, as well as when to enter a trade. Now, with that said, let's move on to and take a look at a simple and a very effective moving average based strategy. If you look at this chart, this is the Euro USD daily chart, and these I have plotted two exponential moving averages here. One is the 50 EMA, the other is the 100 EMA. So, like I said in the previous slide, that crossovers are not a good indication, or they don't tell you when to open a trade. If a trader wants to open a trade, they should basically either enter a trade when the price bounces off, or should use support and resistance levels. Use the faster exponential moving average to understand the direction of the currency market. For example, if the 50 EMA is below the 100 EMA here, the trader ideally should only take the trades which are going in this direction, or rather a short trade. Whereas here, if the 50 EMA is above the 100 EMA, the trader should go long. Enter a trade when price has either bounced off from a faster EMA, like here, this is the faster EMA. 50 EMA is the faster than the 100 EMA. It is more sensitive to the price changes, or if the price has bounced off a support or resistance level. Now, since here the 50 exponential moving average is below the 100 exponential moving average, it's a good idea to open the trade when the price breaches this support level. As you know, once a price breaches a support level, it becomes a resistance level. So if you look here, the price breached this support level created by these 2-3 lows. It came here, it tested the price again, and then it moved on in this direction. So this candle will be a good place to enter a trade. Same way here, the price broke below this low created by this low created earlier, and then it broke down. So this candle will be a good idea to open a trade. When that is done, there are two ways to place a stop loss. Either you can place 15 pips above this, or if you have taken a trade from by the price bouncing from resistance from the exponential moving average, the price can be 15 pips above this exponential moving average price. So, for example, if this exponential moving average price is at this point is 1.3000, then the stop loss can be at 3015, and then a person can keep trailing the stop loss as the moving average goes. So, for example, at here, the trader can adjust the stop loss to be 15 pips above the price of exponential moving average here. So yeah, it's a very simple and very effective trading strategy. Go ahead and use it. But there are 2-3 mistakes I want to emphasize again. Never use moving averages without knowing forex candlesticks. If you don't know forex candlesticks and you try to use a moving average, your trades may end up in a loss more often than not. The second point I want to emphasize is forex moving averages. Per my experience, or per my understanding of the charts, I've seen that they work best when used on a 1 hour chart or above. At 15-minute chart or 5-minute chart, the moving averages are not that reliable because there is too much of noise, there is too much of whipsaw, and the trades, if based on the exponential moving averages, they typically end up in loss. And just to emphasize the point again, don't use moving averages crossover to open a trade. Crossovers to open a trade is not going to be beneficial. And last but not the least, don't plot then 2 moving averages on the chart. Keep the thing simple. Just plot 2 exponential moving averages, or if you're more comfortable with simple moving averages, go ahead and plot 2 simple moving averages, but don't plot them more than 2. It's just going to lead the confusion. So never use moving averages without knowing forex candlesticks. Forex moving averages work best on charts with duration of 1 hour or above, based on my understanding or based on my analysis of the charts. Don't use moving averages crossover to open a trade, and don't plot more than 2 moving averages on the chart. With that said, thanks for I know that you have spent a lot of time watching this video, and as we know, time is money. So here's a small free gift to you. Like I said, forex candlestick is very important to know when using the moving averages. So what I have done is I have identified 2 highly effective forex candlesticks pattern that work very well with the moving averages. I know one candlestick mistake that most of the traders, rather 50% plus traders, make. I also am going to share you one highly accurate forex trading strategy which is based on candlesticks. All you have to do is go to my website forexcandlestickmagic.com and you can get all these things without you have to spend any money. Go to my website and this is my free gift to you. 2 highly effective forex candlesticks patterns which work amazingly well with moving averages. One candlestick based mistake which 50% plus traders make, and one accurate forex trading strategy which is based on candlesticks. Just visit my website. Thanks for watching this video. I also would encourage you to subscribe to my channel. There are a lot of videos I have already posted and I'm planning to submit more videos. I typically post one video every 2 weeks. So definitely you want to subscribe to my channel and watch out anything new which I'm going to share with my subscribers. Thanks and have a nice day.